It's been a record-breaking year for SIPs and for the mutual fund industry. When you look at this trend of how SIP culture is increasing, number of demat accounts are increasing, do you think this is again like a multi-year cycle, or this is more like a bull market phenomenon, more like Barsati Mendak?
So, Nikunj, I think this is as structural as it can be. And you have been in the industry for a very long time. I've been here for 30 years. And I do recall clearly that 30 years back, 20 years back, even 15 years back, I mean, most of the time we used to spend just explaining the nature of equities, just explaining the what are SIPs. And I think collectively the industry, people like you, media, the regulator, intermediaries, banks, relationship managers. I think collectively we can feel good that we have done a great job and we have taken equities to the common man. And today, I mean, no one asks you, should I invest in equities? No one asks, what is SIP? I think that's a wonderful achievement. And we always used to regret that the benefits of India's growth are being not shared by its own citizens, and the way foreign ownership was increasing relentlessly from zero to it went to almost 25% over 20, 25, 30 years. I think fortunately that trend has changed. So I feel extremely happy and that this retail participation is so strong, and I don't see any reason why it should slow down. In fact, as more banks which have remained behind in distribution, as they pick up pace, and as fintech will now kill distance, and fintech, you don't need physical distribution, you can go to the remotest corners. I think this will only gain momentum. So clearly there could be variations year to year, but I think something very important has been achieved, and that is taking equities to the masses. Until 10 years back, they were restricted to the classes only.
So Prashant, just to wrap it up with one final question. When I started my career, the word which we loosely used on Dalal Street was tip. Now the tip has been replaced with SIP. So one has to find out a tip, how to start a SIP, or what SIP allocation should happen from here. What would you advise? I'm asking you this question not only for equity but in general for other asset classes also, because there is a debt, there are balance advantage funds. Is it time to check on the asset allocation now?
Because as we have discussed so many times, and I think you have always kept the focus on the retail investor, and I think this is again a very apt, very good question. See, as we have discussed number of times, the key to equities is getting your asset allocation right. Equities over long periods is like traveling, let's say, in a car, is moving at 12, 14 kilometers an hour, and bonds are maybe you are on a bicycle moving slower. There is volatility in both, but longer term equities do compound much faster. 4 to 6% or 6 to 8% is what we can expect. And over time, this 4 6% higher compounding leads to great outcomes. As you can see from the journey of Sensex itself, there are many funds in India where NAVs are up 100 times last 30 odd years. I think there are two ways to invest in equities. One is you can invest lump sum, and I mean, nothing wrong with that. If you genuinely feel you look at the value after 5 or 10 years, I think it is perfectly all right. But what happens is that near-term markets are always volatile, and if you invest a very large amount and markets drop, you feel a little more upset, even though you are a long-term investor. I think SIP comes in extremely handy. It's a very simple way to invest. You simply spread out those investments over a few months, quarters, or years. And then even if markets correct, I mean, one, the impact is less because you have not invested all. And two, you are investing at those lower valuations also. So it lowers your average investment index. I think SIP is a great way. It's a simple way to invest, and it also ties in with the monthly income that most of us experience. How much SIP you should invest, how much you should invest in equities, I think the answer to that is again very simple. Whatever you invest in equities, you should be able to spare that for the long term, 3, 5 years for sure, hopefully for 10 years. And you should also be able to handle volatility around that. I think if we get our asset allocation right, I think there is no reason why equities will not work for us over the long term.